Well, India's largest PV maker or passenger vehicle maker, Maruti Suzuki, delivered its results, and it was a miss, it was a disappointment when you're comparing it to the street estimates. However, given the fact that there were so many moving parts, number one, the second wave concern, number two, rising COVID cases, number two, the kind of demand environment that had seen a bit of a resumption post lifting of the lockdown in 2020, again taking a bit of a breather or taking a bit of a break. Amidst all of this, Maruti Suzuki struggled to actually manage to meet the street expectations. Now, despite all of that, when you're talking about the numbers, the results overall, especially when you're talking about the revenue, in line with what the street was anticipating, the gross operating margin of the company took a hit, which is why most of the analysts have been forced to downgrade EPS estimates for the company. When you're talking about the overall results, revenues are coming in a little over 24,000 crore rupees, core EBITDA coming in at close to 1,990 rupees, and when you're talking about the margins of 8.3% this time around, and due to that the profitability has actually gone down on a year-on-year basis close to 1,165 crore rupees. Now, this is something that the street believes is a bit of an underperformance when it comes to Maruti. Concerns about receding market share too have been raised. Now, when you're talking about the results itself, margins were hit by weak product mix as well as a sharp rise as far as raw material cost is concerned. Remember, most of the car companies are grappling with very high input costs, while companies have managed to offset this partially by taking price hikes. They are worried that repeated price hikes or sharp price hikes may actually impact demand and thereby impacting volumes. So when you're talking about the net sales, jumping almost 32% on a year-on-year. It was driven by almost 27% rise as far as volumes is concerned, and a 4.5% year-on-year rise when it comes to the average selling price. When you're talking about the EBITDA were hit sharply given the fact that the company was operating with an inferior mix model or an inferior model mix, and also weak gross margin. Now, profitability fell mainly due to weak operational performance, and there was a significant impact due to a 90% drop as far as the other operating income was concerned. The company also saw a bit of weakness given the fact that some of the investments of the company actually saw a bit of a dip. So overall, a weak margin of 8.3% was well below the consensus estimates of close to 9%. Margins were hit by the sharp rise in raw material costs despite very robust top-line growth. The weak model mix is something that is hurting the margins. The company, in terms of going forward, the model pipeline is something that will become very crucial for the company, including an UV launch. Cost reduction effects are something that you need to watch out for, outlook on alternative fuel, and also what is the plan of Maruti when it comes to the entire diesel segment, given the fact that competitors have been quite aggressive when it comes to this particular space.